changes to Australia's tax system impacting CGT and trusts, announced as part of the federal budget just over a month ago. My name is Andrew Nicola, and I'm a tax partner here at William Buck, and I'm joined by a panel of tax experts from William Buck SA's tax division, being James King, Anthony Dello, and Hugh Robertson. And together, we're here to unpack the federal budget and what it means to you. So thank you for joining us on this gloomy and wet Adelaide morning to hear a bunch of tax nerds talk about the federal budget and how it can impact your business. So what's in today's session? There's a bit to cover, so we'll dive straight into this. Well, what we'll do at a glance is cover what's unfolded over the last month, and I can't believe it's only been a month since the federal budget was announced. It feels like we've been talking to clients and businesses about the impact of the federal budget to their business for the last 4 years, and there's been a lot of media attention, so I think that's exacerbated our conversations. Importantly, we're going to talk about why does it matter and how it impacts you, and go into some specifics and provide some detail. We'll importantly talk about the CGT measures and how it impacts businesses and investors, and talk about trust measures. These are also significant big changes. What we'll also do is talk about what businesses and investors need to consider before 30 June 2026, before 30 June 2027, and before 30 June 2028. The way the draft legislation for CGT, but also the announcements, because we don't have draft legislation for the trust rules, are structured, it is tiered in that there are specific actions before specific dates or suggested actions before specific dates. But we'll cover that in a bit of detail. So what has unfolded over the last month? As everyone's abundantly aware, on the 12th of May 2026, the federal budget was announced. And now they announced various tax measures, including proposed changes to CGT, taxation of trusts, and negative gearing. Now, there were some leaks and smaller announcements prior to the budget. However, I think it's very fair to say that it took everyone by surprise, the breadth of the changes, particularly to CGT and taxation of a trust. So as an advisor, I was very surprised to see that the number of assets and the breadth of assets that are impacted by this beyond what we thought would be impacted, which was just residential property, particularly in respect of the CGT changes. On budget night, some fact sheets were released, but no draft legislation, which is very common. The fact sheets, like I said, provided different dates and time periods in which proposed legislation would be announced and when the proposed changes will be implemented. But overall, this is the biggest tax changes for private and mid-market groups in the last 25 years. I personally haven't seen changes to the tax system this significant since the introduction of the GST regime. There's been some tinkering since GST, particularly in respect of self-managed super funds and clamping down on tax benefits there. But now I'll draw short at saying this is tax reform. I just think these are significant changes. But these changes go at the heart of private groups and middle market Australia, in our opinion. Now, we'll try to be very hard to keep this apolitical. However, these changes, if they do come in their current form, will result in more tax being paid by private groups and businesses. And it's not being critical, but that is the intent of the legislation. If you look at the draft legislation that was announced, the intent of the legislation is to tax, particularly in respect to CGT, gains at less concessional ways, effectively align the tax treatment on sale of assets and creation of gains to salary and wage earners. So there will be more tax to be paid on the sale of assets, and that is a deliberate attempt by the government to create that alignment. On the 28th of May, so a couple of weeks ago, certain legislation was introduced to Parliament, and there were two bills covering the core CGT proposals, negative gearing, the WATO, so the Working Australian Tax Offset, and the $1,000 standard deduction measures. These tax bills have been referred to Senate Economics Legislation Committee, and there's public hearings at the moment, so yesterday and today. And you probably would have seen some announcements or some media attention in respect to the draft CGT legislation that has been referred to the Senate Economics Committee. A lot of business groups are lobbying against the implementation of some of these changes, and it would appear perhaps the government is buckling under a bit of pressure. So there may be some carve-outs introduced as separate legislation or tweaks to the current legislation to carve out startups and potentially small businesses from the proposed CGT legislation. But at the moment, everything's in, and we'll cover the implications of that in a bit of detail. Now, separately but tied separately to the federal budget, but really important for private groups, is there was a court case that was handed down 6 days ago. It's called the Bendells case. And effectively, the Commission of Taxation was unsuccessful in what is a landmark case impacting trust distributions to companies where the trust distribution remains unpaid, i.e. the trust retains the cash, doesn't physically pay the distribution to the company. Effectively, the Commissioner was unsuccessful in determining that that creates a Division 7A loan. And I'll explain the importance of that tied with the proposed trust changes in a bit of detail at the end of the presentation. So why does it matter? And why does it matter to you? Well, these proposed measures are big, and I'm not being dramatic about them. They are significant. They could change the way you distribute income. They may require a restructure of your whole business, and I'll explain why. These measures hit at the core of mid-market and private groups, being CGT and trust. Now, most groups in Australia, private groups in Australia, would have a trust in their structure. Either the business itself is operated within a trust, or it's operated within a company, and commonly the shareholder would be a trust. And ultimately, over the life cycle of a business, either an asset sold or the business is sold, and there's CGT implications. So changes to both the CGT and trust impact private groups at their core. Now, every discretionary trust will need to be considered for their effectiveness. There may be some tweaks in terms of the way trust income is distributed, or alternatively, if your business operates within a trust, a restructure may be required. Particularly if you operate your business within a trust, you need to reinvest those profits, and you've been managing those trust distributions and managing your effective tax rate by distributing your company. That strategy will not be effective under these proposed rules from 1 July 2028, and Anthony will cover that in a bit of detail later in his presentation. So the structuring of business assets, investment holdings, and private groups will need a fundamental rethink. Now, factors in deciding an appropriate structure, there are obviously a number of factors to consider when deciding an appropriate structure. Now, obviously includes tax on income, tax and gains, and hence why you might need a restructure. But importantly, those commercial elements are still there and still need to be considered when acquiring an asset or when considering a restructure. And they include asset protection, whether you have limited liability, the funding, how you fund the business going forward, understandability of your structure, and also estate planning, succession planning. The acquisition of assets in individual names or a trust or a company have a significant impact on all those factors. So all that needs to be considered. Ultimately, there will be no one-size-fits-all solution, and the nuances of your group need to be applied to these proposed changes, and you need to work closely with your advisor depending how heavily you are impacted. So what I'll do is I'll hand over to James King, who'll talk about, ease into these new changes and talk about negative gearing and CGT. So I'll hand over to James King.
Thanks very much, Andrew. Hi, everyone. It's great to have you on board listening to this important webinar. So as Andrew mentioned, I'll start off with the proposed changes to negative gearing. So I guess just to frame it, it's a reasonably common term, but just as a bit of background, negative gearing occurs when an entity's deductions relating to an income producing asset or investment exceeds the assessable income that the entity earns from the investment in an income year. So when this occurs, the entity's net loss can be applied against their other assessable income. So it might be salaries and wages or business income or other investment income. And this results in a reduction in the entity's taxable income for the year. So this generally encouraged leveraged property investment due to the tax advantages provided from negative gearing and also the 50% CGT discount. So under the proposed changes of this budget, from the 1st of July, negative gearing for established residential properties will be abolished. So there's an important distinction here and quite inconsistent terminology in the draft legislation as well. New builds or new residential dwellings are exempt from these proposed negative gearing changes. In other words, new builds, you can continue to negative gear. However, if it relates to an existing or an established residential dwelling, then the negative gear or these negative gearing changes will apply, basically disallow the negative gearing. So under the proposed changes, a net rental loss on an established residential property will be quarantined. And these quarantined rental losses can be carried forward and applied against income from other residential properties in future years. So the quarantined net rental loss from one residential property can be applied against the net income of another residential property in the same entity's portfolio. So if you have a number of these properties, you can apply the quarantined loss from one property against the income of another property in your portfolio. It's not tracked property by property. As I mentioned, under the proposed rules, new builds are exempt from these changes, and that means investors in new builds will be able to deduct rental losses against all their assessable income. So there are some important exclusions from these rules. So firstly, these proposed changes only apply to residential properties acquired after the federal budget night. So that's 7:30 p.m. Australian Eastern Standard Time on the 12th of May. So the properties held before that, before budget night, are grandfathered, and these investors can continue to apply the existing negative gearing rules, as in they can still apply negative gearing. As I mentioned, eligible new build residential properties will be exempt from these changes, so owners can continue to access negative gearing and can continue to deduct rental losses against their other income. So new build is a very important term here, very important distinction. There's a little bit of commentary of what that means in sort of a practical sense. So if you had a single dwelling, like a home, and you knocked it down and you replaced it with a townhouse, 2 dwellings, a duplex or more, then those 2 additional properties would be considered a new build. We've increased the housing supply to Australia, so that means it's a new build. If you have a single dwelling and replace it with another single dwelling, that won't be a new build. It doesn't add to the housing supply. So that's an important distinction with these rules. And we're expecting further guidance on what exactly qualifies and doesn't qualify. These exclude the negative gearing rule changes also don't apply to commercial property investments. You can continue to negative gear those. Shares and other types of capital investments as well continue to negative gear. There's certain types of entities that aren't subject to these rules, so widely held trusts and superannuation funds, and that there are specific types of properties that are also exempt, so build-to-rent developments and supporting, where private investors are supporting housing programs. So moving on then to the significant changes announced in the federal budget on CGT regime. So there are broadly 3 key changes that they're proposing. The first is the 50% CGT discount will be replaced by cost-based indexation. Secondly, there'll be a 30% minimum tax rate on capital gains. And lastly, there'll be a removal of the full exemption from pre-CGT assets, so those assets that were held before 20th September 1985. Now, these are significant changes, as Andrew mentioned. Importantly, the legislation has been introduced to Parliament, but they're not yet law. These measures have not yet passed, and so it's really important that we continue to track and monitor the development of these. Before we go into the changes, I also wanted to highlight that there are key types of CGT assets that are not impacted by these changes. So first of all, the main residence exemption. So your family home will continue to be exempt from FBT. And the other is the small business CGT concessions. So these concessions allow small business owners to reduce or even eliminate the tax payable on a capital gain. They are incredibly powerful and can make a significant impact to the cash a small business owner might be left with after selling their business. So with the proposed changes to the CGT rules, there's now going to be this significant gap between taxpayers who can access the small business CGT concessions and those who can't qualify for them. And so as such, this makes planning for future sales even more important than ever before. Just some quick CGT concepts before we go into the changes. These aren't this more sort of common terminology. So capital proceeds, this is typically the amount that you receive for selling an asset. So it can be cash and assets that you receive, or the value of assets that you receive. Cost base is broadly what you paid to acquire the asset, and it includes other incidental costs like stamp duty. It also includes costs for improving an asset. Capital gain is generally the difference between capital proceeds and the CGT cost base of a CGT asset. Capital loss is the difference between the reduced cost base over the capital proceeds of the CGT asset. Reduced cost base is slightly different to the cost base, but for the purposes of this webinar, I won't go into that detail. And then finally, a net capital gain. So net capital gain is what is actually subject to income tax in an individual's tax return. And this is what you're liable to pay tax based on your marginal tax rate as an individual. Just quickly, this is the current method statement for determining your net capital gain under the existing rules. Basically, what are your current year capital gains if you've got more than one CGT event? And then you can apply prior year capital losses or current year capital losses in the order that you choose. And that's the really important part. Under the existing rules, taxpayers, individuals have a choice of what losses we can apply against which capital gains, and effectively, potentially, leaving a greater portion of discountable capital gains left, which are then eligible for the 50% CGT discount. So these are one of the significant changes to the proposed rules that Hugh will go into more detail shortly. So as you might be aware, under the existing 50% CGT discount rule, basically reduce your capital gain by 50%, and this applies to eligible taxpayers, so Australian resident individuals and trusts, or discretionary trusts distributing to Australian resident individuals. And the CGT asset has to be held for at least 12 months. So if you're eligible for the 50% CGT discount, your capital gain is effectively halved. And what that means is for a top marginal tax rate payer, the effective tax rate on that gain will only be 23.5% rather than 47%. So under the proposed changes, the 50% CGT discount will be replaced with cost-based indexation. So this change will apply to capital gains where the CGT event happens on or after the 1st of July 2027. So under cost-based indexation, the cost base or purchase price is adjusted for inflation when calculating capital gain. So the aim is that only the inflation adjusted increase in the asset's value is subject to income tax. The indexation, the CPI inflation adjustment, will apply to each element of the asset's cost base that's incurred on or after the 1st of July. Importantly, like with the current 50% CGT discount, cost-based indexation is only available to eligible taxpayers, so Australian residents, and for assets that are held for more than 12 months still. There are carve-outs to these proposed rules. So new builds, again, new residential dwellings, they're carved out from these rules. Investors in that case can choose whether they want to apply the 50% CGT discount or cost-based indexation. So just want to provide a very quick example, simplified example for how the two methods work. So in the left-hand column there, it's under the existing rules, CGT discount. Sorry, just as background in this example, individual Australian resident purchases an investment property for $1 million, and 5 years later they sell it for $1,500,000. And this assumes that there's 2.5% annual inflation, which is probably a bit unders at the moment, but that's just for the example we've got now. So in the column on the left, CGT discount, the capital gain is $500,000. So different between proceeds and cost base. However, then after applying the 50% CGT discount, the net capital gain is $250,000. So that's in the red square on the screen. And that means that the income tax payable is only 47% on the $250,000. So net tax payable, or tax payable, about $1,117,000. The example on the right, so this is under the proposed indexation rules. You'll see there that the indexed cost base in the green square is basically the original purchase price adjusted for inflation, so over the 5 years. This then reduces the capital gain that you're realizing. So $370,000 is now the capital gain under indexation. There's no CGT discount, so that's not applicable in this example. And you'll see there that the tax payable is now $173,900. So in this example, the indexation is going to result in additional tax payable for an individual of about $56,000. So again, we're anticipating that these changes, rid of the CGT discount, replacing it with indexation, is going to result in a greater tax liability for investors and taxpayers. Further change that's been announced under the proposed budget, further change that's been proposed under the budget is a 30% minimum tax rate on capital gains. So this is exactly what the headline sort of says, that from the 1st of July, taxpayers are going to be liable for at least 30%, subject to at least 30% tax rate on their capital gains. This applies to all CGT assets, so shares, other investments, things like that. Now, for investors that are already on the top marginal tax rate, this probably won't make an impact. However, investors that are on a marginal tax rate of less than 30%, again, this is probably going to increase your tax liability going forward. They have, government and in the proposed legislation, have flagged some carve-outs and some exemptions to this. So firstly, recipients of income support payments, age pension, disability support, JobKeeper, apparently not subject to these rules. And also, again, similar sort of carve out for new residential dwellings, new builds. So they will continue to or not be subject to these, these new rules of 30% minimum tax rate. So I think it's.
Yeah, thanks, James. That was that was really useful and highlights the complexity of both negative gearing and the CGT regime going forward. Just got a basic example to demonstrate the complexity of indexation. If I'm an investor and I buy BHP shares for $1,000 for each year for 5 years, so I've got $5,000 of BHP shares, and 2 dividends are announced every year, and I select to reinvest them through a dividend reinvestment plan, do I need to index each of these items when calculating the capital gain?
Yes, it's an excellent question, Andrew, and that's correct. You do. So it's indexing each component of the cost base of each CGT asset. So when you, which is calculated when you eventually sell the asset, but requiring the right information and documentation to substantiate that calculation as you acquire these shares or as you're reinvesting, and creating more components of the cost base. So yes, indexation does require those additional steps, and realistically, that's going to be a lot more complicated for people to calculate the capital gains. It's going to be more substantiation required if the ATO was to ever scrutinise these calculations from what's disclosed in your tax return. And I think realistically, it might make it harder for people to prepare and lodge their own individual tax returns because of that complexity. So yes, I think it could have significant ramifications going forward.
Absolutely. That sounds awfully messy. What I'll do now is hand over to Hugh, who'll talk about the new CGT regime under the proposed measures and highlight the importance of the different buckets of assets and acquisition dates.
Thanks, Andrew, and thanks, James. And thanks, everybody, for joining us today on this presentation. And as mentioned, I'll be jumping into some capital gains discussion in a bit more detail. So just to summarise and dive a bit deeper into these proposed changes, what we have is gains accruing up until 30 June 2027 being subject to the current CGT rules, i.e. the grandfathering, and gains arising post 1 July 2027 will be impacted by the updated CGT rules. So it's really important to understand the status of the CGT assets and the dates they were acquired. And that'll be important in determining how capital gains are going to be calculated in the future. And it's important because there's an introduction of these 4 new categories of capital gains that you need to work through and to determine how gains and losses are calculated for yourself. And it'll also be really critically important to determine market values of assets at 30 June 2027 at the beginning of the proposed changes to the CGT legislation. So following on from those points, determining market value at 30 June 27 is going to be critically important for all assets. And that's because that market value is going to be used to calculate the capital gain on those assets up until that date. So you know how much of any future capital gain realised on those assets will be subject to the current CGT rules. And it'll also set the cost base or the starting cost base for those assets in calculating any capital gains that are needing to be calculated under the proposed changes from 1 July 2027. So there are a couple of categories on the slide here that I'll just talk to and just discuss how these proposed changes may impact. So pre-CGT assets, which are those that were acquired prior to 20th of September 1985, have historically been tax-free, subject to some specific provisions and CGT Event Case 6. However, under the changes that have been proposed in the budget, any gains accruing after 1 July 2027 will become subject to CGT. And so in this instance, determining the market value of your assets at 30 June 2027 is going to be critically important to calculate what portion of any future capital gain is exempt and tax-free and retains that pre-CGT asset, and what portion post 1 July 2027 is going to be capital gains under the new proposed legislation. For assets acquired between 1985 and 1999, under the current law, you can choose between indexation or the 50% discount, and they could come up with different outcomes under those calculations. From 1 July 2027, only indexation will be applicable to those post 30 June 27 portion, and any amount pre 30 June 2027, that accrued gain, you'll still be able to access the 50% discount, assuming you're an individual or trust and you satisfy the provisions necessary. But again, calculating the market value of assets at 30 June 27 is going to be critically important to know how much of the gain you're going to be eligible for the discount on and how much of a future gain you won't be eligible and you'll have to apply indexation to. And for assets acquired between 1999 and 30th of June 27, same theme, accrued gains to 30 June 27, you'll keep the 50% discount on those accrued gains. and any gains accruing after 1 July 27 will be subject to the indexation and the minimum 30% tax rate. So just to reiterate, getting a valuation at 30 June 27 is going to be very important to determine how you calculate those capital gains and what amounts will be subject to the previous CGT provisions and then the proposed changed CGT provisions in the future. And failure to adequately get a market valuation that can be substantiated could lead to unfavourable outcomes in the event of any ATO review in the future if many years pass and they need to determine market values for assets looking back into the future, and it's not easy to do. That could result in some unfavourable outcomes for yourself. So the proposed changes introduce these 4 categories of capital gains. We have deferred gains, which are the portion of the gain that accrues up until 30 June 2027. And they're the ones, as I mentioned, that potentially can access that 50% CGT discount on their sale. And they're referred to as deferred because technically a gain will be made at 30 June 2027. However, it'll be deferred from being included in your tax return until the asset is actually sold at a later point in time. There are 2 types of deferred capital gains: deferred residential capital gains, which are gains relating to residential dwellings, and deferred non-residential capital gains, which are gains relating to non-residential assets, for example, shares. There are also then other gains, which are the portion of any capital gain that accrues from 1 July 2027, and they will be subject to indexation. And there's 2 subcategories of other gains, being residential capital gains and non-residential capital gains, again having the same meaning, where the residential gains relate to residential dwellings and non-residential gains relate to non-residential assets, such as shares. So why do those categories matter? Well, deferred gains will potentially be discountable or exempt if they're pre-CGT assets and whatnot, and the other gains will all be subject to index cost bases. And why is there a distinction between residential versus non-residential? Well, that's because, as James mentioned, with the proposed negative gearing changes, where there are rental losses on residential properties and they exceed the rental income in that year, that loss gets quarantined. It can only be offset against future residential rental profits or against the capital gains on that residential property when it's sold. Hence, there are deferred residential gains, and they can have the quarantined amounts from the rental losses on those properties offset against them. So the way in which capital gains are calculated has been updated. James showed us the method statement earlier that stepped through the steps you need to go through in terms of calculating your capital gains. The proposed changes update that. So as I said, there's the 4 categories, and the starting point of any capital gain calculation will be determining what category a particular gain falls into. Now, the categories are listed there in an order with deferred non-residential, deferred residential, non-residential, and residential capital gains. Now, that's the order they need to be classified in. And it's important because in the updated method statement, that is the order that you need to apply the steps. And that's critically important for losses and the application of losses. So that has changed. So once you've categorized it into one of those 4 categories, you then start working through the steps in the method statement where you reduce each of those totals to 0, but not below 0, and you follow those steps. So for example, step 1, you apply your current year capital losses. Step 2 is you apply carry forward net capital losses from earlier years. Steps 3 and 4 is where you'll apply quarantined residential rental losses, which will come off those deferred residential gains first and residential gains. Step 5, you may apply any discount percentage if you have any deferred non-residential or deferred residential capital gains left over after applying losses. And step 6 is where you'd apply your small business CGT concessions, if any, that are applicable. And step 7 is you add up what's left, and that is your new capital gain. So to walk us through an example just to sort of illustrate how that will work. We've got an example here, assuming that we are in the year ended 30 June 2033, and you have $200,000 worth of carry forward losses from disposals in earlier years that you've brought forward. And you sell a beach house in February 2033 for $3.2 million. And that was bought in December 2018 for $1.5 million, and it has been rented out. The market value at 30 June 2027 was $2.5 million. You did the right thing and you went and got a market valuation at that date, so you have a market value. So at a high level, there's a calculation for the deferred residential gain, being the difference between the cost being 1.5 million and the 2.5 million market value, gives us a $1 million deferred residential gain. The index cost base of that property is $2.7 million. And so in calculating a residential capital gain on the period from 1 July 2017 until the date it was sold, we take the $3.2 million capital proceeds amount and we subtract the $2.7 million index cost base, and that gives us a $500,000 residential capital gain. We also had ASX listed shares, and we sold them in June 2033 for $500,000. We bought them in January 2033 for $380,000. So we have a $120,000 non-residential capital gain on those shares. So we've got three categories, three numbers, we've got a loss. So let's walk through how the steps apply and what our capital gain will be under the proposed measures. So as I said, there is a deferred residential gain, being the difference between the market value at 30 June 27 of the beach house of $2.5 million and its cost when it was originally acquired of $1.5 million. We also have a non-residential gain of the $120,000 on the ASX shares, and we have the $500,000 residential gain on the beach house, being the difference between the sale price of $3.2 million and the indexed cost base of $2.7 million in that period post 1 July 2027. So we've laid out the steps on here, and as mentioned, you no longer can choose the losses and how they can be applied to different assets. They must be applied based on the method statement. So there are no current new capital losses to apply, but we have the $200,000 carry forward losses, and that needs to be applied against the deferred residential gain first. So that reduces that gain by $200,000 to $800,000. There are no quarantine losses in this example, but if there were, they would be applied against this gain at this time. Step 5 is we are able to discount that gain by 50% because it would satisfy the requirements under the legislation. And so that removes another $400,000. So we have a net capital gain of $400,000 on our deferred residential gain. The non-residential gain is pretty simple. It's just the proceeds less the cost. It's $120,000. We have no losses, so we have $120,000, and then we have the $500,000 residential gain on the difference between the capital proceeds and the index cost base of the beach house when it was sold. So in total, we have roughly $1,020,000, and at the top marginal tax rate, you'd be looking at a tax bill of around $479,000. And so just to compare that with what the current system would produce, in the current system, we would have a gross capital gain on our beach house being our capital proceeds of $3.2 million, less the $1.5 million cost base. And then we would have a $120,000 gain still on those shares. In total, we'd have a gross capital gain of $1.82 million. Now, under the current method statement, you can apply losses strategically. So you would get the biggest bang for your buck by applying as much of the losses as possible against the $120,000 on the shares, which are non-discountable. So you would reduce that to nil, and you're left with solely the capital gain on the beach house, which you would then reduce by the $80,000 leftover losses. It would leave you with about $1.62 million in capital gains, which would fully be discountable. it would then be discounted down to about $810,000, and at a tax rate of 47%, that gives you $380,000 in tax payable. So as you can see from that example, there's roughly a $100,000 difference in those amounts. And so under the new regime, there's a few changes. The changes with the way losses are applied in the categories, and calculating different types of capital gains for different types of assets. So just a key takeaway from me is ensuring that there's some pre-30 June 27 planning and valuations considered, and considering the timing of disposals, which could be worth many thousands of dollars per asset, depending on the types of capital gains you have. So relatively complex. That's my example there. So I'll jump over to trusts now, Andrew.
Yeah, Hugh, that was a really good example. I think the losses and the application of losses now really diminish the value of capital losses. So you're right, tax planning before 30th of June each year is fundamentally important. Just a quick question on valuations, because this gets raised often by clients. What is required for a valuation? Does a taxpayer need a formal value to value an asset, which could include a private company shares, or a warehouse, or a residential property?
Well, it depends. So obviously for listed investments such as shares and things, it's easy to attain a market value of those assets at that date. But best practice would be to get a proper valuation done on those assets, as they can often be very specialized, very difficult to value with just getting any sort of market data. And it'll just ensure that with a proper valuation, there's a defensible methodology that any ATO scrutiny can be. You can show the method that was used, and that would help in substantiating those market values you have.
Yep. So it sounds like value is going to be pretty busy on around 1 July 2027. We'll pass on to Anthony now, who will talk about trust and the fact sheets that were announced that impact trust distributions going forward.
Yeah, thanks, Andrew. So yes, onto the sort of the last big topic announced as part of the budget measures is this proposed 30% minimum tax on discretionary trusts. So importantly, we don't have any more information today than we did on budget night. There's not been any draft legislation that have been released on these measures as yet. So we really are we are working from the commentary provided by Treasury as part of the federal budget papers, and from the government fact sheet, the explainer sheet that was released at the same time, which is about 5 pages long and is, in my opinion, pretty short and sharp for some measures that are fundamentally going to change the landscape of private groups in Australia and how they hold their wealth. And so it's just that the changes are big. I would say they're fundamental and landscape shifting for affected taxpayers. So what do we know? That the headlines are that, as we've alluded to earlier in this presentation, from 1 July 2028, trustees of discretionary trusts will pay a minimum 30% tax on their taxable income. So fundamentally different than how trusts typically are operated, i.e. a flow-through vehicle with beneficiaries bearing the ultimate tax burden. Now there will be a taxing point at the trust level before the income is distributed to any of the beneficiaries. Individuals and other non-corporate beneficiaries should receive non-refundable tax credits for the tax paid by the trustee. Now I'll come back to that in a little bit more detail later on with some examples. But crucially, it's the credits will be non-refundable, and also if you're a corporate beneficiary, it appears that there will be no credit available, which leads to some pretty catastrophic outcomes if we were to follow a well-trodden strategy of distributing to bucket companies or other beneficiary companies. So what that means is trustees will be required to calculate, report, and pay the minimum tax at the trust level, and then notify the beneficiaries to whom they distribute their income entitlements, as well as the amounts of tax paid on those amounts. It's also possible that trustees that receive franked dividends will be required to use those franking credits as a means of paying the minimum tax. So there are some exclusions from these measures, or proposed exclusions. The big ticket item there is fixed trusts, which should contain unit trust. However, the definition of fixed trust is probably not as clear as what we in the tax community would like it to be. So important to speak with your advisor in a little bit more detail before you just go ahead and assume any unit trust is a fixed trust, because there is a little bit of complexity around that. But other types of trusts that are proposed to be excluded are widely held trusts, complying superannuation funds, and other disability, deceased, and charitable trusts. And there's certain types of income that's also potentially excluded. The primary production income is interesting. So that's effectively, for lack of a better phrase, agricultural or farming income. We don't have much extra detail on what that means just yet, but it does appear that there will be some exclusions for that type of income. The last point there around income from assets of discretionary testamentary trusts existing on budget night is an interesting one. You may have heard some media coverage about the backlash on this and a so-called death tax. It's not quite that, but the measures do appear to effectively reduce the concessions that were allowable in respect of testamentary trusts, which were a key, or were and are a key estate planning tool for many private groups. So there has been a fair bit of coverage on that. So it would be interesting to see where that lands as well with any draft legislation that's ultimately released. So what's the government doing? So what they are doing is they are very clearly incentivizing restructuring away from trusts. They're not hiding it. They're being very, very clear about it. So they have released statements that there will be expanded rollover relief proposed effectively for 3 years from 1 July 2027. And they're also planning to provide additional assistance through the Australian Small Business and Family Enterprise Ombudsman and ASIC for taxpayers that effectively want to restructure away from trusts. They're trying to make this as easy as possible, which remains to be seen, because very few things in tax and structuring are easy, but they are clearly pretty keen for as many taxpayers as possible to get away from trusts. So some known unknowns. So what don't we know, and what is still subject to consultation prior to draft legislation being introduced? So we don't know what the precise minimum mechanisms are for collecting that minimum tax. It's likely going to be, we would think, done in the same way as when a trustee currently is required to pay tax on certain amounts. So in instances where, for example, a trust does not have all of its income distributed, the trustee is assessed on amounts, and that same approach applies in a few other scenarios as well. But we would presume it will be done in a similar way to that. We're not sure what happens if franking credits exceed the minimum tax liability and how that will work. And crucially, we're not really sure what this expanded rollover relief looks like. There are already in certain business settings rollovers available for trusts to move to companies, as an example. But the key thing here that we're thinking about is all of this is federal tax. It doesn't have any bearing on state tax. So if you have a fairly commonly used trust structure to hold residential property, for example, hence all of the discussions earlier around residential gains and negative gearing. Well, if we restructure that away from a trust to a company, for example, I see it's very unlikely that the state governments are going to provide stamp duty relief on that transaction. So it becomes, there'll be some tension here around how these measures are practically going to be implemented by taxpayers in the community, and whether issues like state tax actually become real barriers to that. So quotes from Treasury in their fact sheet. So draw your attention to the last point. As I said earlier, they're being really clear on this. So the introduction of the minimum tax will reduce the incentive for trustees to distribute to corporate beneficiaries set up just to receive trust distributions from discretionary trusts. And they've actually said this will discourage the use of structures that add complexity to the tax system. Not sure that's why they're why they're keen for taxpayers not to use corporate beneficiaries, but they're being very clear about it, that they don't want to see this this structure moving forward as far as they can. So we thought we'd put together a few examples, just in a few different fact patterns. Now, we're looking at how trusts derive different types of income and where that income is ultimately distributed and where the tax is paid. Through these examples, there's a bit that goes into those calculations, for example, use of franking credits and the like, but the key headline will be effectively, as we've done with the other sections, what's the effective tax rate? On $1 of profit, how much tax at the end of the day is going to be paid along that journey? And I think that's what most people are interested in. So we've kept the examples relatively simple, but there is a bit of work that goes on behind the scenes to calculate that. The first example we have is an example where a business is operated in a trust. It distributes $200,000 of income to dad, who's on a higher marginal tax rate of 47%. Mum's on a sort of medium tax rate of 30%, receives $50,000, and there is also an adult child with no other income that receives the remaining $50,000. Now, I've got on the left what would the current tax paid by each entity within that structure until 30 June 2028, compared with what that looks like with the introduction of the minimum 30% tax from 1 July 2028. So currently, as we mentioned earlier, trust typically pays no tax. It's a flow-through vehicle. Dad receives $100,000, apologies, and pays 47% on that, pays $47,000 in tax. Mum gets her $50,000 and pays 30%, $15,000, and the tax payable by the adult child after considering the impact of the tax-free threshold is just shy of $6,000. Where that effectively gets you to is an effective tax rate of 33.89%. With that introduction of the 30% minimum tax, though, the trust pays, or the trustee pays, that 30% tax at the trust level before the distribution to dad. So before any income is distributed, $60,000 is distributed. Dad then takes the $100,000 distribution and can get a non-refundable credit for the tax paid in the trust. So his $47,000 instead becomes $30,000. It didn't matter for dad that it's not refundable because he's on the top marginal rate anyway. Mum has her 30% tax rate individually, just effectively offset by the credit from the trust. But crucially for the adult child who's on a below 30% rate, that credit is now non-refundable, and accordingly, no tax is paid by the adult child, but also no refund is available to the child, and therefore where we get to is an effective tax rate of 38.5%. So an increase of close to 4 to 5% there. The second one is the second example is a distribution to a corporate beneficiary, and this is the big one that's attracting a lot of attention at the moment, because this is a very sort of standard procedure in private groups in Australia at the moment. Excess profits are typically distributed to bucket companies and reinvested. So we'll assume that there's $100,000 of business income in the discretionary trust again, and it's distributing 100% of that income to a bucket company who's not eligible for the reduced 25% tax rate and has a 30% tax rate. So current position is, again, till 30 June 2028, no tax is paid at the trust level, so tax payable by trustee is nil. On the $100,000, the corporate beneficiary pays $30,000. Pretty simple, 30% effective tax rate. From 1 July 2028, however, that 51% effective tax rate you see is what we think is the best case scenario, because we don't have any information around whether actually there will be a gross up required for the tax paid at the trust level. It's possible it could be 60%. We're working on the assumption that effectively it would be the $70,000 net that's accessible to the corporate beneficiary, but it is possible it could be the grossed up amount. Now, where that leaves you is effectively a 30% tax paid at the trust level and a further 30% tax paid by the corporate beneficiary, with no credit available at all to the beneficiary. And what that means is that, as I said, at best, an effective tax rate of 51%. So effectively renders this structure completely redundant from 1 July 2028 if the measures are enacted as announced. Now, I've just got to note the significant increase seems to be government's or Treasury's intention. They're being very clear about it, as I said, that they do not want this structure to be plausible moving forward. What does that look like, though, when that income is then taken out from the company to the individual shareholder in this assumption? Because it's all well and good to talk about taxing levels along the journey, but ultimately an individual is going to put their hands on the income. So in that case, again, we would say that there's a grossed up $70,000 dividend accessible to the shareholder, who would receive the amount net of tax, the $49,000 in cash, but would be required to gross up for the franking credit from the company. That individual then would have potentially further tax to pay on that amount, further top-up tax, and it's possible that you could be looking at an effective tax rate along the journey of close to 63% under this scenario. So again, as I said, something that is just simply not going to be pursued moving forward if the measures are enacted. There's also an additional a plausible scenario where there's franking credit leakage along the journey. So in this third example, we have a company that's 100% owned by a discretionary trust with a 30% tax rate, has a net trading income of $100,000 per year, pays those profits to the discretionary trust, who then pays that or distributes that net income to an individual beneficiary. Assuming that the individual beneficiary has an effective tax rate of 20% and had other deductions of $30,000. The current position would again be that the tax payable by the trading company would be the $30,000. Then at the end of the journey, effectively because of the refundable offset for the franking credits, the individual previously would have got effectively a much lower tax payable because they would have had a refund of the excess franking credits. I'm just conscious of time, so rather than going into the detail of the table on the right, the net impact is because those offsets are non-refundable, we have a significant increase in the effective tax rate in this example, and what effectively amounts to lost franking credits or leakage of franking credits that would not have applied under the current rules effectively. And as you can see, a significant increase in the effective tax rate. So what does this all mean for using trusts as a structuring vehicle moving forward? So as we said, there's no additional tax where income from trust is already taxed at 30%. If everything is going to a high tax environment, you may get to the same conclusion. But post 1 July 2028, it's probably not going to be possible to have a less than 30% tax rate on discretionary trust income. And it's possible that bucket companies from that date are effectively dead. We're also conscious that we could have a scenario where there are wasted franking credits in the example that we just went through. And in that case, tax planning is going to be really, really important, effectively, or even more important than it otherwise would have been. There are 3 income years left under the current rules, 26, 27, 28, because the measures apply from 1 July 28. And as Andrew noted earlier, the recent impact of the Bendel High Court decision could offer some real opportunities for taxpayers over that time to try and get funds into beneficiary companies as far as they can before the measures take effect. And then again, it's about planning proactively to consider the appropriateness of using discretionary trusts in existing or new business or investment structures. So there's no one size fits all category. It does really come to the facts of each case and the goals that you're trying to achieve.
Great, thanks for that, Anthony. There's a lot in that, and I'm conscious we've just hit time. So what I was planning to do was just to quickly summarize the actions each financial year up until 30th June 2028. I am conscious of the time, so I'll just be headline actions for each year. So for 30th June 2026, this is a bit of BO alert and slightly alarmed. There's no major rush to do anything regarding restructuring your trust or anything like that. What you should be doing is just considering whether you should distribute income to a corporate beneficiary, given the High Court decision of Bendel, and the fact it won't be a strategy from 1 July 2028. So getting income out of, if you have a corporate group, into more of your private group, might be an opportunity to start doing that over the next 3 years. Before 30th of June 2027, obviously get your valuations like Hugh said. If you have pre-CGT assets, really consider that nothing's caused them to become a post-CGT asset. So really a review of your pre-CGT status is important. This is the year that obviously valuations for CGT, but also if you are impacted by the trust measures, which should be have draft legislation announced by then, planning for a restructure if you need to restructure. So working with your advisor to review, assess, and plan on potential actions that impact your group. So by then, we should have the proposed CGT restructure rules, which Anthony highlighted, but also we still have existing CGT rollovers and a small business CGT succession. So there's 3 key tools in your toolbox that can restructure you from a trust to a company if you need to. Now, when I talk about restructure, it's important to know these are real transactions. It's easy for me as the advisor to say, oh, just restructure and do this rollover. The rollover only takes care of the income tax implications of a restructure. A restructure is the sale of a business from a trust, in this instance, to a company, and that requires notification, communication to banks, talking to your employees, talking to suppliers, talking to customers to let them know that, hey, there's a new ABN, there's a new ERP, there's new payroll system. So that takes resources away from your business's usual activities to just undertake that restructure. So planning is important for that year if you're impacted. And like Anthony said, this restructure rules are only in respect of deferring the income tax application. You still have stamp duty considerations to take into account. So they could get in a position where you've got this great CGT rollover that defers the tax implications so you can move from a trust to a company. But if you operate in sort of problem states or have problem type of assets that attract stamp duty, could have a real negative stamp duty implication. So you really need to consider both in tandem. And obviously, before 1 July 2027, consider the use of distributing to beneficiaries, corporate beneficiaries, because that will be the second to last year. Before 30 June 2028, it's about implementation. If these rules do come in and you do need a restructure, you're implementing that restructure. Do not leave it too late because it takes time and there'll be resources required to do this. And this will be the last year of using your corporate structure. Obviously, from 1 July 2027, you're in the new CGT regime. So any sale of assets, you need to do that at apportionment, like Hugh highlighted. So I want to flag lastly that there'll be another federal election. Likely the latest will be May 2028. Obviously, there's been a lot of pushback regarding these proposed changes. So you never know what might happen in that financial year, but we are working on what information we do have on at this stage and when information does come out. So I hope you found today's session useful. There's a lot in that. We appreciate that. If you have any questions, feel free to submit them through the questions chat function. Feel free to email us. Feel free to contact your local advisor. We'd be happy to do another presentation when further legislation comes out. If you found this useful, please do not hesitate to provide your feedback. I hope you enjoy the rest of your day and look forward to speaking to you soon. Thank you.